What does 1 trillion even mean? It's a 1 followed by 12 zeros, a stack of $1,000,000 repeated 1,000,000 times, more than the annual GDP of countries like the Netherlands or Switzerland. That's the scale of Elon Musk's potential Tesla payout, and it's reshaping how we think about CEO pay, shareholder power, and whether markets still reward value over hype. So, how exactly we got here? Tesla shareholders approved a record-setting performance-based equity package for Musk, with over 75% of voting shares in favor at the 2025 annual meeting in Austin. Proxy advisors urged no, and large institutions like Norway's sovereign wealth fund opposed it. But retail investors and the board backed Musk's vision as essential to Tesla's future. The plan is structured as 12 tranches of stock options or restricted shares, vesting only if Tesla hits ambitious operational and market cap milestones over the next decade. If fully realized, Musk's stake could rise from roughly 13% to around 25%, adding an estimated 423 million shares, implying a potential $1 trillion windfall if Tesla reaches an $8.5 trillion valuation. One may think, what 1 trillion means in context. $1 trillion dwarfs most corporate pay in history and rivals sovereign budgets. The package's magnitude is designed to be earned, not guaranteed, requiring extreme execution on vehicles, robo-taxis, humanoid robots, and core profits. It's an audacious bet that Tesla becomes a multi-trillion-dollar AI and robotics platform, not just an automaker. Before discussing further, let's check Tesla's valuation versus sales reality. As of mid-2025, Tesla's market cap hovered around $1.1 trillion, more than Toyota, Mercedes, BMW, Volkswagen, and Ford combined, despite selling far fewer vehicles than legacy peers. In 2024, major automakers sold roughly 68 million vehicles, while Tesla sold about 1.8 million, only about 2.5% of that total. The gap between valuation and unit sales is the heart of the overvaluation argument. Yet Tesla remains among the most profitable per vehicle, about $7,000 average profit per unit in recent analyses, even after margins compressed from earlier peaks. Financially, Tesla's unit economics and software potential keep bulls confident that valuation reflects future platforms, not current volumes. This thing always comes to my mind. Who owns Tesla and whose money is at stake? Musk is already Tesla's largest shareholder, and the package would increase his ownership if milestones are hit. Opposition from large institutional investors like Norway's sovereign wealth fund underscores that a meaningful share of Tesla equity is held by global funds, pension pools, and retail investors whose returns depend on future performance, dilution, and governance discipline. Public shareholders approve the plan. That means public money, via funds and retail holders, is effectively underwriting Musk's incentive. Critics argue those dollars should flow as dividends or buybacks. Supporters counter that equity-based pay aligns Musk's gains with long-term value creation and keeps him focused on execution. But there is another question. Is it fair? Comparing CEO pay, this package is unprecedented in size. While tech giants like Apple, Google, and Meta pay their CEOs handsomely, nothing in the current landscape matches the scale or risk weighting of Musk's plan. The design is performance-linked, but the upper bound, $1 trillion, dwarfs typical CEO compensation across the industry. Historically, Musk's earlier $56 billion 2018 options grant was already record-breaking before a Delaware court questioned board independence and called it excessive. Then, Tesla shifted legal strategy and proposed a new, far larger plan tied to far steeper milestones, reflecting shareholders' belief that Musk is uniquely capable of delivering outsized outcomes. This then leads us to production reality check. Let's do that by comparing Tesla versus legacy automakers. Unit sales matter. Toyota, Mercedes, BMW, Volkswagen. These companies sell far more vehicles than Tesla and do so without awarding trillion-scale packages. Tesla's defenders say the company isn't being valued as a car maker alone, but as an AI, energy, and autonomy platform, hence the emphasis on robo-taxis and robots in the pay triggers. Even in competitive segments, data points show Tesla's presence varies by market. BMW and Mercedes outsold Tesla in luxury EVs in specific months and regions. Volume leadership is not uniform, and growth targets remain steep. The pay plan's credibility rests on execution that closes the gap between narrative and numbers. Now let's try and put the case for and against. First, let's discuss the case for. The equity-based pay links Musk's rewards to shareholder value, milestones are extreme, approval was democratic, and keeping Musk fully engaged may be priceless if Tesla truly becomes an AI and robotics platform worth multi-trillions. If targets aren't met, he doesn't get the full award. Now that the case for is done, let's move forward with the case against. The valuation already outruns unit sales by a huge margin. Dilution could hurt public holders, dividends are absent, governance concerns persist, and concentrating power and wealth in one individual raises systemic risk. For many, this looks less like incentive and more like a transfer of public shareholder value to one person. It's valid to ask whether this is public money being redirected away from dividends and broadly shared returns. It's valid to ask why a company with comparatively modest unit sales warrants a trillion-scale CEO award. It's valid to ask if this is overvaluation, daylight robbery, or a visionary prepayment for future platforms. The only honest answer, the package is a high-stakes bet. If Musk hits the milestones, shareholders may celebrate the cost as justified. If he misses, it will look reckless. Investors should demand transparent progress against each tranche. Vehicles delivered, autonomy deployed, robots shipped, margin sustained, and market cap earned, not imagined. In markets, conviction must be proven. 1 trillion demands proof.